Good afternoon, hello and welcome. You're watching MF Corner. I'm Sumaira Abdi. Today it's a day to answer all the queries that have been coming in from our viewers. So we have two experts joining in, Lavai Navlakhi, Managing Director and CEO at International Money Matters, and Himanshu Srivastava, Senior Analyst and Manager of Research at Morningstar Investment Advisers. Good afternoon, gentlemen, to both of you, and I hope you're both doing well. Himanshu, of course, we've been chatting with, but Lavai, good to see you after a very, very long time. I hope both of you are doing well.
Yes, Amar, good to see you too, and I hope you are also doing well.
Yes, thanks so much. Thank you. Okay, let's get started. The first query that comes in is from Jay Shan. He's written to us on Twitter and he wants to know about the concept of averaging. So recently in my series Market Simplified, I had done a short video on averaging in stocks. But now what Jay Shan wants to know is, how do you average in mutual funds? The example that he has given is that in an NFO he has invested for the past 20 years and that's given huge gains. So is it worth averaging in mutual funds at a higher NAV? Himanshu, do you want to clarify what to do here?
Yeah, sure. So normally the most permanent way of averaging one's investment in mutual fund is by investing via the SIP mode. The best thing about SIP is that one need not have to time the market. They can contribute investing a fixed sum every month on a regular basis in a mutual fund scheme. Thus, over a period of time, it helps in rupee cost averaging. That is, it brings your investment costs down. Now, averaging in stock and that in mutual funds are different concepts altogether and should not be interlinked. Also, one should not confuse high NAV with high stock price. They both are different. A fund with high NAV stands an equal chance to capitalize from the market opportunity as a fund with lower NAV. It's a myth that high NAV is expensive and provide a low return on investments compared to the funds with low NAV. NAV levels are not important while making investment decision in mutual funds. In mutual fund, the investments are done from a long-term perspective based on one's financial stability, risk appetite, and investment horizon, among other factors. So these factors, if these factors are intact, you can continue your investment in a fund even if it has a high NAV, with the only condition being that the fund is apt in an investor's portfolio. So NAV level or market level doesn't really make too much of a difference in terms of if you're looking for investment over a longer time frame.
All right, so that's the concept of averaging with respect to mutual funds. Now, a Twitter handle that goes by the name of Raging Critic, yes, has written to us and he wants to know how taxation works for an SWP or a systematic withdrawal plan done on a debt mutual fund, and he also wants to know if it is a more tax efficient alternative to partially withdrawing a lump sum amount. Lavai, you want to take this?
Yeah, sure. So, Sumaira, first and foremost, wonderful being back on your show after really long. So, thank you for having me. Systematic withdrawal plan is really a method by which you are getting regular cash flows. And you could decide whether, at what amount you required every month and plan to exit a fixed amount every month. So, when that happens, what the mutual funds will calculate is the cost at which you entered, the number of units that you are exiting, and the differential of the price at which you are exiting. On that, you are charged capital gains. Now, if you have not crossed 3 years, then they are treated as short-term capital gains. However, if it's crossed 3 years in the current tax rules, then it becomes long-term. And then the gains get taxed at 20% with indexation. There is one other benefit in terms of exit loads that if you were to withdraw lump sums, you normally get charged exit load. But if you are part of an SWP, many of the funds have an exemption on the exit load, so you are sort of partially benefited from that. So yes, I think there is an advantage of making sure that if you used an SWP, your taxation may be slightly better. But the only caveat is that you can use SWP if you knew that there was a fixed amount every month that you needed.
Okay, so that's the concept of taxation on systematic withdrawal plan for debt mutual funds. Now, here's an interesting query, and this one is coming in from Teja Atluri, who has also written to us on Twitter. Now, he says he has invested in two funds. That's the Motilal Oswal Multicap 35 and the HDFC Small Cap Fund, where he's chosen the direct growth option, and he has been investing via monthly SIPs now for 3 years. He wants to know if what he should do: hold, sell, switch to a new fund or an AMC. Teja, I want to I've appealed many times in the past, and I want to use this opportunity once again to appeal to everybody who's sending in queries is to send in all the details. It's really not fair to an advisor to be advising you on piecemeal investment, and that's really not the approach. It should be a more holistic approach, and therefore if you want advice on your portfolio, you have to give the advisor all the details. But Himanshu, I'm assuming therefore, for the ease of this answer and for our understanding, that the portfolio is limited to just these two funds. Okay, Himanshu, I think you've put us on mute.
Sorry for that.
No, go ahead.
Yeah. So what I'm saying is, if these are the only two funds in the portfolio, then it requires further diversification, definitely. Now, coming to these two funds, that is SGFC Small Cap and Motilal Oswal Multicap 35. So SGFC Small Cap, as the name suggests, invest in a small cap segment of the Indian equity markets. Now, this segment is, we all know, is very high risk, high return investment proposition. They tend to witness intense volatility during troubled times and may fall more than the large cap and mid cap counterparts. So there is an element of risk. So investors need to have the right risk appetite to stay invested in this fund. Now, Motilal Oswal Multicap 35 on the other hand has a mandate to invest across market segments, that is large, mid and small cap. But if you look at the portfolio over a period of time, this has been largely run like a predominantly large cap fund. Now, what is important is that it follows the focused investment approach, when it typically invests a maximum of 35 stocks in the portfolio. There are certain inherent traits in such an approach, and that needs to be understood very clearly. These funds run a relatively concentrated portfolio across stocks and probably across sectors as well. While this helps the fund when the manager's investment decision pans out as expected, they may also result in sharp underperformance if the investment decision goes wrong. So they can witness sharp upside as well as downside, one of the elements that investors need to keep in mind while investing in such funds. To mitigate these funds, obviously one need to construct a portfolio of funds which complement each other. Though Motilal Oswal Multicap 35 has a predominantly large cap portfolio, but I would still suggest that you invest in a dedicated large cap fund in your portfolio. These are those funds which are more stable compared to mid and small caps, or maybe multi-cap fund over a longer period of time, and they protect reasonably on or during the downside. So what we have seen in the markets of 2018, 2019, and in the earlier part of 2020 as well. Some of the funds that you can consider investing in are Adit Birla Frontline Equity, which is a growth-oriented style, and you can complement it with a valuation-conscious approach, which is SGFC Top 100. From an overall portfolio perspective, large cap funds can account for roughly 60% of the portfolio, followed by 25% in mid caps, 15% in small caps. These allocations can be tweaked to some extent based on one's risk appetite. Now, coming to whether you should stay invested in SGFC Small Cap Fund and Motilal Oswal Multi-Cap. So SGFC Small Cap can continue to be a part of your small cap portion of your portfolio. On the multi-cap side, I would recommend that once the current SIP cycle gets over, you can divert the future SIP amount to another multi-cap fund, such as Kotak Standard Multi-Cap, from diversification perspective. And over a period of time, you can build your portfolio around that to reach the recommended asset allocation for your portfolio.
Okay, and now, Lovai, I'm going to throw a very interesting query your way, something that a lot of us have been asking for a good, 1-2 years now, and Vivek Kapoor has put it into a question for us. He wants to know about the procedures that AMCs, or that's the mutual fund houses, follow when they're taking collateral from their bond issuers. Now, over the years, SEBI has also stepped in to tighten, the norms over here, but to explain to a lay investor or a retail investor, could you put the process down in very, very simple terms?
Yeah, I think the important thing that we have to recognize is that the AMC and the fund manager and the team is there to protect the investor and to grow the value of the investor. We should make that assumption first, because I think for them the criticality is maintaining the assets and continuously adding more to their assets. That's how they grow. Now, in the debt mutual fund schemes, what had happened in the past was that whenever one of the fund houses was making an investment there and they found that there were certain doubts in terms of getting back that money, and there was a little extra risk. What they were doing is to protect the risk. They were taking some shares as collateral, and we don't do know that in the case of a couple of fund houses, when they had shares as collateral, they were able to liquidate the shares and recover their money. So to that extent, the investors in the debt funds did not suffer a loss. I know that there have been cases where in the past where bonds have been issued or bought by the mutual funds, and despite having collateral, they were not able to encash, or the price fell too much and they were not able to do it. And I think now SEBI has really stepped in to make sure that some of these procedures are transparent and they are fair to investors. I think that very importantly, we have to know that when we are investing in debt, typically we as investors tend to look at, okay, if something's giving me 6%, can I get something which is 7? Can I get something which is 7.5? And you have to recognize that as soon as you decide to opt for little higher return, you are sacrificing, security to some extent. So as long as you are clear that my money in debt is, first and foremost, I have to have return off capital, then I can get return on capital, then you are fine. But I know as human beings, we all get tempted and say, "Ha, isme to there is not much risk. Never mind, let me get this 1% extra." So be a little careful about that when you're making investments, and you hopefully won't make blunders that some investors have made in the last couple of years.
All right, I hope our retail investors are able to understand it. It's a complex situation, but Lobai has tried his best to make it very, very simple. And of course, the market regulator also has been tightening regulations. Vaibhav Ladda has written to us on Twitter, and he wants to know about the dynamic debt fund category. He wants to invest in it and wants to know how to approach them given the low returns prevailing on bank FDs as well as liquid funds. Himanshu?
Yeah. So dynamic bond funds, as the name suggests, manages their duration dynamically. These funds try to capitalize from the interest rate movement in the economy and taking higher returns. To achieve that, the duration of the funds are increased or decreased depending on where the interest rates are headed. Generally, the duration is increased during falling interest rate scenario, and it is decreased during the when the interest rates are moving up. So these funds carry duration or interest rate risk. The another risk that these funds carry is the execution risk, as its success would also depend on the aptness of the manager's reading of interest rate scenario. Therefore, given these risks, they shouldn't be core funds in an investor fixed income portfolio. They should typically play a supporting role. The core part of the debt portfolio should have funds that doesn't take credit risk and also doesn't take much of duration risk as well. So funds from, say, ultra short, low duration, short term and corporate bond categories, given that those funds which don't take credit bets out there, can be the core exposure. Now, keeping this in mind, and from the diversification perspective, you can consider having some exposure to well-managed dynamic bond funds, having an established track record, but obviously the quantum of investment should be much lower than the core portion of your portfolio, and that is largely from the diversification perspective. So one of the funds that you can consider investing is in IDFC Dynamic Bond Fund, but obviously you need to understand and completely comprehend the risks which are attached to these funds, though they don't take credit risk, but there is a interest risk and duration risk, and if the things goes wrong, then they can drag the performance down. So the risk aspect needs to be very well understood.
All right, on that note, we'll take a very quick break, come back, lots more mutual fund queries when we return. Stay tuned. Welcome back to MF Corner. Lavai Navlaki of International Money Matters and Himanshu Srivastava of Morningstar India are our two experts today, and we're answering the queries sent in by our viewers. The next one comes in from Alok Agarwal, who's written to us on Twitter. He says he has accumulated equity now for the last 17 years and then stopped buying. He intends to hold the existing equity mutual fund portfolio for the next 15 years, presumably for retirement. That's right. He says he wants to know if this is the right strategy to create a retirement corpus. Lavai, this looks too straight-jacketed to me. Would you think he requires to be more flexible?
Yeah, Sumera, I think that, when you're sort of planning for retirement, typically you're sort of looking at a corpus that you're building as you work towards retirement, and in retirement you're going to use the money that you have accumulated to take care of your requirements by way of expenses, regular travel, medical, so on and so forth. So typically what we would suggest is to have a basket of investments for the retirement. You cannot depend on just one asset class. So I'm assuming that he already has maybe some other diversification other than this equity mutual funds. On the part of, let's for a minute assume that he has those parts and now he's looking at only the equity mutual funds.
Okay, I think we'll try and reconnect with Lavai in just a bit, but I'll just complete the point that Lavai was making, that, assuming that he has only equity mutual funds, he'll also need to keep reviewing it. You cannot buy it just in isolation. Lavai, you want to complete your point?
Yeah, can you hear me now?
Yes, go ahead.
Okay. So I was saying that even if I assume that the equity mutual fund is one portion of the portfolio, I think thinking that one particular equity fund or basket of funds is going to serve its purpose for 17 odd years may not be the best things. Because let's say you had done this 10 years ago, there weren't too many index funds available in the marketplace. There was no categorization of assets in the mutual funds. So you might have been in very actively managed funds and done very well. But as we've got into categorization of mutual funds and also creation of indexes, we find that some of the index funds may not really underperform these actively managed funds, especially in large cap space, etc. The second thing is that between the equity funds, the allocation between large cap, mid cap and small cap may tend to vary at different points in time. So you should have the flexibility to move them a little bit up and down. And finally, as he approaches retirement, for sure, a few years before that, he has to start cutting down the risks in the portfolio. So, fill it, shut it, forget it type of thing might not work in this case.
Absolutely, Lavai. Okay, the final query today comes in from Abhay_VK, another Twitter handle, who's written to us, wants to know if there is any mutual fund scheme that deals purely in interbank call money, and also wants to know if there is any short-term fund that is shorter than a call money instrument. Himanshu?
So I think Abhay can invest or consider investing in overnight fund category, funds from this particular category. This category of funds typically invest in overnight securities having maturity of 1 day. If he wants to have a slightly higher maturity and slightly higher returns, then he can also look at liquid funds where the investments are made in securities maturing within 91 days. And these are the two categories in the mutual fund domain which has the lowest maturity profile. There's no other category which has a maturity profile lower than these two.
All right, Himanshu, Lavai, thanks very much for joining in and for advising our viewers. As always, I've learned a lot too during the show. Thanks much for your time. We'll wrap up on MF Corner, but do stay tuned in. The team of Closing Bell will join you next.